On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the debut episode of the Torres Report. I am your host, Todd Schoenberger, and the star of the show is none other than the senior economist at Interactive Brokers, José Torres. Jose, what do you think? The debut episode, are you nervous?
Todd, not nervous at all. I love hanging with you and talking with you. It's going to be a terrific program. We have a lot to talk about. We got geopolitics, we got earnings, Supreme Court tariff decision, Fed Chair Powell's DOJ investigation,
So much.
rates, long list of things to talk about. We probably won't get to all of it, Todd, but we'll be able to talk about a few things.
Well, this could be a 5-hour show, actually, but we don't want to keep the audience that long. But to bring the audience up to speed, this show will air every Wednesday at 2 o'clock Eastern. The purpose of the 2 o'clock time frame is because when the Federal Reserve meets, they render their decision at 2 o'clock Eastern. So we want to make sure we're live and covering it with Jose. So big brains on the leadership at BTT for that one. But Jose, all seriousness, so let's start talking about the economy. Last Friday, we just had the jobs report release, and it came in less than expected. What do you think, though? I mean, what does this say about the health of the labor market?
Well, the labor market is in good shape. We have the immigration restriction that's really hampering the total payroll potential. So we're not going to have job gains in 150,000, 200,000 as normal like we had in the previous administration when you had an open border and you had expansive labor supply. You also have AI adoption that's hampering some of the white collar industries. A lot of the entry level jobs are now they're more efficient. AI is doing a lot of those more routine tasks. And then the rate sensitive areas, namely construction, manufacturing, and small business, rates have come down, but they still remain too high for those sectors to flourish. However, the unemployment rate did tick down to 4.4%. That was good news. But part of the reason it decreased was because 45,000 people left the labor force. Participation rate ticked down to 62.4%, still well below the pre-pandemic peak of the pre-pandemic level rather of 63.5%, really due to excess retirements after the pandemic and shifting demographics. The economy, though, shouldn't be judged, Todd, by how jobs are doing overall in this backdrop. It should be more about productivity, GDP, and consumption. We got those stale retail sales numbers this morning. They were particularly strong. GDP has been terrific. Atlanta GDP now is at around 5%. Productivity also very strong. Employers doing more with less workers, using that technology to get the growth ahead. The investment has also been terrific. President Trump we're expecting this year in 2026, a lot of the taxation package and the measures passed in 2025 are now going to turn into more pronounced tailwinds, hopefully in 2026.
So there's a lot of positives that are out there. You seem very optimistic. Yesterday, we had the inflation data on the CPI. Today was the producer price index. The numbers they're off of their peak levels, Jose, but there are some areas that are still showing some elevation, i.e. rents, for example. What do you think what components of inflation are most important to the Fed? What do you think the Fed is focused on when they're going to meet in a couple of weeks?
Yeah, well, I think they're absolutely focused on the labor side of the mandate more so at this juncture because since early 2021, we've essentially allowed inflation to be above target. So really, it's 70-30 more so on the labor side, 30% on the inflation side. So if labor starts to weaken, if inflation is where it's at right now, then the Fed will cut quite significantly. We're looking for 100 basis points of reductions this year if the labor market starts to weaken. So call the unemployment rate 4.8%, 4.9%. If we get up there, then that would justify those kinds of cuts. I think they'll be looking at the tariff inflationary pressures, which really are behind us and were very, very muted. So they're going to still watch that. I don't think we'll see a flare there. And really services, that's really, the big component there. Labor intensive services, but also housing. The immigration story has really quelled the the inflationary aspect of housing. Rents have been slow. Home prices have been decelerating significantly. We saw this morning existing home sales 34-month high,
Yeah.
highest since February of 2023. But that's because prices are coming down, Todd. Year over year, prices only up roughly 0.4%, barely anything. So you have flat prices. But that immigration restriction, however, that is supporting higher wages. In that jobs report, we saw average hourly earnings up 3.8% year over year, above the previous 3.6% and the median estimate, which was 3.6%. So you have a little bit of an offset. The immigration restriction, it pushes down housing costs, but it does support higher wages.
So let me make sure I understand this right. You are calling for 100 basis points in cuts this year?
No, if we have the unemployment rate go to 4.8 or 4.9, I'm at 75 basis points of cuts. Because I
Which
think
is still
that,
very aggressive, actually.
yeah, it is aggressive. The dot plot says 1, Wall Street says 2, I'm at 3. I look at the real-time measures of inflation, and we're going to be, Todd, at 2.4, 2.3% very soon. When you pair that with President Trump putting someone in there that presumably is going to lean increasingly dovish relative to Chair Powell, then you could probably add one more on top of what Wall Street is expecting.
So speaking of the Fed, do you think that it's the timing of the cuts or the magnitude of the cuts that's most important?
I think they're both more important, and it depends on the context. So for investors, it would be more so the timing. Magnitude would be more significant if we were heading into a downturn. So timing, if you have well-timed rate cuts, that's great for markets. But if you have a rush down to the basement, that's bad for markets because that means that the Fed is rushing down because it sees economic conditions starting to slow, perhaps contract, and that threatens the buoyancy of corporate earnings, of course. But that's not where we are, or where I think we will be. But that's sort of how I think about timing and magnitude.
So you brought up the Fed and the potential change of leadership, which is imminent, actually. By May, Chairman Powell will have vacated the position of chairman. He can remain as governor, though. But there is some drama that just came up over the weekend with the Department of Justice launching a criminal investigation on the chairman over his handling of the renovations at the Fed. What are your thoughts here on this, Jose? I want to get your opinion on this. Do you think that there's where there's smoke, there's fire? Is that what we're looking at here? Or do you think this is another way to try to manage the chairman out of the role?
I think it's more so the latter. I think it's part of political pressure to try to get what the White House wants. Um, I don't like the scenario. I think that the chairman is out in May. Let him finish out his term, and then select someone else. I don't. I think the pressure is unwarranted at this juncture. Yeah, that's where I'm at, Todd.
Well, he has the right to remain governor, though. Do you think that this might be the way to just try to get him to just remove himself entirely?
Maybe, but I don't think so. Chairman Powell is a man of principle. He really cares about the institution. He spent a long time there. He's been there, Todd, since 2012, off of the top of my head. That's 14 years. So he cares a lot about the institution. He used to make a lot of money on Wall Street working for the Carlyle Group. So this is not a man who's chasing wealth. He's already there. He's chasing duty. He cares about the Federal Reserve. He cares about maximum employment. He cares about price stability. He cares about American institutions. So I think he's going to stay on as governor, Todd, because I think that he doesn't want his legacy to be tainted by him leaving his role because of political pressure.
My theory is that this is an angle to another story. We still haven't resolved the Lisa Cook issue with the Fed, and they're also or were some whispers and rumblings that they were trying to get Austin Goolsbee out. So going forward, you're absolutely right. In only 4 months, the chairman's gone anyway. You still have to bring in someone. They still have to go through the congressional hearing as far as being approved to be put into the chairman role. So with that being the case, I have to wonder why now, and I have to think that this must be smoke and mirrors where there's something the DOJ is trying to get, but it's not the chairman, it's something else. That remains to be seen, but we'll see what happens there. Let's turn the page, though, to the Fed, because now going into that dovish picture and the overall economy, and then you throw in the big beautiful bill. That's we're seeing a lot of the benefits from that. You also have all this AI capex spending that's taken place. What are your projections for GDP for 2026?
Very strong, up at 3.4%. One of the strongest years in quite some time, driven by what you just said. That package that's going to incentivize a lot of investment, first year 100% depreciation on CapEx on a lot of different categories, broad based. That's going to be terrific. Hopefully that can lift manufacturing employment and orders. And then also you have deregulation, more of that coming on the way. You have fiscal stimulus. The president now at the midterms, President Trump won because of affordability. Affordability remains an issue in America. You still have high prices. You still have high interest rates. He's trying to do the credit card stuff, the cap on the 10%. He's talking about pandemic style household checks of $2,000. Right now is the time where President Trump is going to try to please the constituency. And that means more fiscal stimulus, a stronger Trump put, and as a result, I think we're going to have a higher market. But after 3 years of a strong bull run, returns roughly 24% in 23, 23% in 24, 16% in 25, way above average. This year I think is a positive year because earnings are going to be strong, but expect some bumpiness, expect some turbulence because valuations are elevated. And after such a significant run, especially with the recent trajectory, Todd, of the 3 years on, 1 year off. We had that down year in 2018, 19, 20, 21 were great. 22 was a bad year. 23, 24, 25 were strong years. So, if you're superstitious, then maybe 26 is a down year. But the fundamentals are very strong. So, it's hard to see a down year. But some turbulence, a little bit of volatility, I think, could be expected, especially with the geopolitical stuff. I mean, you have stuff happening all around the world. Caracas, of course. Now we're talking about Havana, Tehran, Moscow, Beijing, et cetera, and et cetera. So who knows how this will play out? And of course, during this Trump term, as well as the previous one, we remember a few, 5%, 7%, 8% drawdowns, driven mainly by geopolitical tensions.
Well, I want to touch on the geopolitical items because what is your feeling? We've seen crude oil prices jump over 9.3% in just the last 5 trading days. That is going to take a hit. That's almost a tax on the American consumer at the pump. So if this continues, and now with the unrest in Iran, and if they do anything with the Strait of Hormuz, you're going to see oil prices just pop and gas prices are going to pop. And then therefore, the American consumer is spending more to fill up their car rather than spending it at the mall. What is your worst case scenario here if the geopolitical tension continues through the first quarter, second quarter? What kind of a drain will that have on GDP?
Well, the great news is, Todd, that we have ample supplies worldwide, and the US is now increasingly in control of Venezuelan supply. So that's the good news. So, in a worst case scenario, 3 or 4 years ago, we'd be talking about oil at $100 or $110. Right now, we're looking at 75 or 80. And of course, it's not just the magnitude of the move, but also how long we stay up there. Because if you just have a quick spike and you come back down, inflationary readings are monthly. So it would be a monthly average, not just, how high did it go in one shot? But absolutely, if we do have oil, let's call it 70 or 75, that can essentially, Todd, wipe off any rate cuts this year, send inflation back to 3%, and it would send the 10-year to 430 or 440, and it'd be bad for the economy and for risk assets. And GDP would still, in that kind of scenario, would still grow, but not in the threes. We'd be in the twos.
Okay. Wow. That'd be something else, and that could be significant then. But one thing that could be very significant is the Supreme Court ruling on tariffs. We are expecting the ruling. I believe it will show up at 4 o'clock or after 4 o'clock Eastern on Friday, because we have a 3-day weekend, so markets have time to digest the news. But what do you think about this? It seems that the Supremes might actually vote against the president on the tariffs. Will we have to rebate $400 billion to countries? And then, if so, what does that mean for the U.S. economy?
Hopefully not. But what it means, if there is an expectation that the court is going to block the tariffs, and without talking about all the alternative verticals that the administration can take to still enact them anyway, even if the Supreme Court blocks them. If you block tariffs, like you said, you got to give back some of that money. That's bad for the fiscal situation. The fiscal dynamic has been terrific, folks, when you consider the deficit has been contracting, and that's great news for fiscal hawks. Another thing that it would be bad. It'd be good, however, for corporate earnings in the short run, because you'd have that fiscal stimulus. A lot of those firms will get that money back. It would be terrible for onshoring ambitions, because that does fuel the onshoring story. So I think those are the main three things: the fiscal situation, the short-term boost to corporate earnings, and then unfortunately declining onshoring ambitions without the tariffs.
Let's turn the page to the markets. We'll close out the show with this. You have a stock market that did exceptionally well last year, despite that overhang of the tariffs, and it seemed that it didn't impact consumers as much as experts had figured it would. This year, going forward, regardless of what the Supremes do on the tariff situation, how do you think? What are you telling Interactive Broker clients? Are you still expecting a further gains in the markets, or just an up and down pattern for the rest of the year?
Yeah, no, I think it's still a strong market. It's going to be a good market. There's a little bit of disagreement on how far we can go, or if we'll have a flat year, and that really puts us in the framework that you should be cautious this year. There's going to be turbulence. There's good idea to put on some hedges sometimes, not be too greedy, not chase too much to the upside, and be ready for some sudden drops or Trump bumps, we can call them.
Okay. Jose, how is it that the audience, because I know you have a wonderful commentary, how can people actually see your musings on the economy?
Oh, absolutely. Yeah. So on Interactive Brokers Campus, IBKR Campus, we have a Traders Insight page, and you'll see a lot of content from our contributors here at Interactive Brokers, like myself, like the Chief Strategist, Steve Sosnick, Director of Trading Education, Andrew Wilkinson, among others. And then, of course, you can see my stuff as well on LinkedIn, on X, as well, José Torres Econ, and of course here with Todd Schoenberger.
That's right. Well, I got to say, Jose, you're one of the smartest economists on Wall Street, and I know we're proud as all else to have you on BTT for this weekly show. So this is wonderful. A wonderful first show, Jose. Wonderful. I can't wait for you to come back next week. I hope we don't have to run a best of, because we definitely have a lot to talk about next Wednesday as well.
Looking forward to it, Todd. See you all next week.
Absolutely. So on behalf of José Torres at IBKR, I am Todd Schoenberger. Thank you once again for joining us on the Torres Report. We'll catch you next Wednesday live at 2 o'clock Eastern. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.